The recession model just crossed 70 for the first time since I built it. Biggest single-day jump all year, from the mid-60s to 72 in one trading session. And the VIX spiked massively, the biggest fear move we've seen since the banking crisis. Markets are freaking out. Iran just escalated military operations. Nuclear facilities are being threatened. The Strait of Hormuz, where a third of the world's oil passes through every single day, is now under direct threat. And the model is screaming that the economy was already fragile before any of this happened. What's up, guys? It's Tom here, and we need to talk about what crossing 70 actually means, because this isn't just another market dip. This is the moment when the probability calculation fundamentally changed. If you've been following this channel, you know the model's been ahead of this stuff. We called the Bitcoin crash in December before it dropped over a third from its peak, while everyone else was screaming about new all-time highs. We flagged the jobs overcount months before the Bureau of Labor Statistics admitted they were wrong by hundreds of thousands of positions. The defensive portfolio I've been running has quietly outperformed the S&P while taking substantially less risk, and now the model just crossed into high-risk territory for the first time since it launched. The track record speaks for itself. This isn't speculation, it's systematic analysis that's been validated in real time. So let me be clear about what 70 means. This is not recession confirmed. That's not how the model works. What it is saying is that the probability just jumped significantly. We're now in what I call high-risk territory, the zone where recessions typically develop, not where they're guaranteed, but where they become likely enough that you need to position differently. The model tracks dozens of indicators across four categories: labor markets, financial conditions, consumer health, and geopolitical risk. Most of them were already flashing warning signs. Jobs creation has basically stalled. We're barely creating enough to keep up with population growth. Unemployment is creeping higher. Consumer sentiment has dropped. Credit card delinquencies are rising, but those were slow-moving problems, background issues that build pressure over time. Then Iran happened, and that's what pushed us over the line. The geopolitical crisis detector fired at elevated for the first time since I built this system. Military operations are escalating, nuclear tensions are building, and sitting right in the middle of it all is a narrow choke point that handles a massive portion of global oil supply every single day. Here's the mechanic that nobody's talking about. This isn't just about gas prices going up. Oil is an input cost for everything. Shipping costs spike, manufacturing costs rise, food production gets more expensive. When oil moves significantly higher, which is where we could be heading, that increase ripples through the entire supply chain. And we already have inflation running above the Fed's target. The Fed is now stuck in the worst possible position. They can't cut rates with inflation problems. They can't keep them high with growth slowing. It's the textbook definition of a stagflation trap. But here's the part that's really important. This geopolitical shock didn't hit a strong economy. It hit an economy that was already showing multiple stress fractures. The labor market was already softening. Job openings dropped dramatically from their peak. Consumer spending was already pulling back on discretionary items. Business investment was already slowing. Corporate earnings growth stalled last quarter. One geopolitical spark shifted the entire model massively in a single session. That tells you something critical about how fragile things already were underneath the surface. Strong economies don't move that fast. They absorb shocks. Vulnerable ones amplify them. When small triggers create big movements, that's your signal that the system is already under stress. And here's what doesn't make sense. The model is at 72. The VIX just spiked massively. Oil is creeping toward dangerous territory. Credit spreads are widening, but up until yesterday, markets were acting like everything was fine. S&P within striking distance of all-time highs. Complacency everywhere. Put-call ratios at historic lows. Nobody was hedging. Everyone was leveraged long. Now fear is finally catching up to reality. The question is whether it's catching up fast enough, because the thing about geopolitical risk is it's binary. Nothing happens for weeks. Markets get comfortable, then everything happens in one weekend. By the time the VIX hits panic levels and everyone realizes we're in crisis mode, you've already lost substantial value and the hedges are too expensive to buy. So there are really three ways this plays out from here. Path 1, containment. Diplomatic pressure works. Tensions de-escalate over the next month. Oil settles back down. The model drops back below 70 and we continue the slow grind higher. Markets breathe a sigh of relief and add gains by summer. That's the best case, maybe a third probability. Path 2, limited escalation. Some disruption to oil supply, a few tankers get turned around. Prices spike temporarily but don't stay elevated as strategic reserves get deployed. We get a standard correction but avoid recession. The model stays elevated but doesn't break into extreme territory. That's probably the most likely scenario right now. Path 3 is the one everyone's terrified about but nobody wants to price in. Full blockade of the Strait of Hormuz. Oil spikes to dangerous levels within weeks. Inflation jumps back substantially. The Fed has to choose between fighting inflation with rate hikes and supporting a collapsing economy. They can't do both. That's the recession path, and it happens fast. So what does this mean for you personally? If you're fully invested in index funds right now, you're essentially betting everything on path one. Maybe that's right. But look at the risk-reward math. It's completely asymmetric. If nothing happens and markets grind higher, you gain modest returns over the next few months. If Hormuz gets blocked, you lose substantial value quickly, and it takes over a year to recover. If you're carrying credit card debt at punishing interest rates while the job market is softening underneath you, that's a problem that gets exponentially worse in a recession. Unemployment insurance doesn't cover minimum payments. If you're house hunting in a market where median mortgage payments are eating nearly half of median household income, higher oil prices make that affordability math even worse. Every meaningful increase in oil prices adds hundreds per month to the average family's cost structure through gas, utilities, and food. And this is exactly why I've stayed defensive since the model launched. Heavy cash allocation, reduced equity exposure to large cap value and dividend-focused positions, minimal growth stock exposure. Same systematic posture I've held since November, despite missing some upside. It's outperformed during exactly these moments of volatility. When everyone else is scrambling to figure out what's happening, you're already positioned for multiple scenarios. That's the entire point of having a systematic, rule-based approach. The model doesn't care about your feelings or mine. It doesn't get FOMO, it just processes data objectively and tells you when risk is building before it becomes obvious to everyone else. Look, nobody wants a war. Not for the markets, not for anything. People's lives are at stake here, families are being disrupted, but pretending the economic risk doesn't exist because it's uncomfortable to think about. That's not a strategy, it's wishful thinking. And wishful thinking doesn't protect your portfolio when reality hits. Bottom line, the recession model crossed 70 for the first time since I launched it. We're officially in high-risk territory. The probability of recession just jumped significantly. Not confirmed, not inevitable, but probable enough that you need to position differently. The economy was already showing stress fractures before Iran escalated. One geopolitical spark moved the model massively in one day. That tells you how fragile the foundation really was. I remained systematically defensive, heavy cash, reduced equity exposure, focus on quality dividend stocks. Same positioning that's worked since November. The model's forecast is now showing heightened recession risk as the most likely scenario. The math has changed, your positioning should too. If you want to track this stuff in real time instead of waiting for my videos, I built a full dashboard at recessionistpro.com. All the indicators, live updates, forecast modeling, no ads, no affiliate links, just the data. Here's specifically what I'm watching next. If oil breaks above danger levels and holds for several consecutive days, the automated oil shock detector fires and the model probably jumps to 75. If it stays contained for the next couple weeks, markets were right about containment, and I'll adjust the geopolitical weighting accordingly. Second thing to watch, naval deployments. If a third carrier group enters the Persian Gulf region, that's not deterrence anymore. That's preparation for sustained operations. Third, credit markets. If high yield spreads widen substantially beyond current levels, that's institutions pricing in recession risk ahead of the equity markets.